because 10-year yields, Rick Santelli, they're back above 4%. We've got a big Fed rate meeting and decision on Wednesday. Where will the focus of your big brain and your market be the next few days?
Well, I think the market's going to answer that question for me. Yesterday it was all about 263,000, a big jump in initial jobless claims. And we saw yields plummet even though CPI was close to expectations. Anybody who thinks it wasn't warm didn't really look at the numbers. And today, I think the market's paying a whole lot more attention to that inflation number because as you look at a two-day chart, 2-year yields and 10-year yields now have higher highs than yesterday, reversing that big move. And I think that's important. It's somewhat of a stagflation trade, which was reflected, Brian, in today's University of Michigan sentiment preliminary numbers. You had weakening on the sentiment side, and you had stickiness on the inflation side, although I pay less attention to inflation of surveys than some of the more hard data like PCE, CPI, and PPI. So I do think that the big deal for the Fed meeting is going to be the fact that we're not going to get 50, we're going to get 25. But beyond that, if this stickiness remains, hey, maybe the market's going to reprice how aggressive this easing cycle will be. We have a double bottom potentially. We rejected 4%, which is the low yield close of the year. You see it on the left side of the chart. We all know treasuries like double bottoms. The fact that this reversed, yesterday when I was out there, I said, if I was in the pit, I would have been selling at 4%, looking for yields to bounce, and that's exactly what they did. And finally, when rate cuts are on the way, all investors are grabbing anything that's got a juicy yield, like high yield, junk. Look at the high yield ETF. Basically, yesterday it closed at the highest level in about 3.5 years. Brian, back to you.